Welcome to our ultimate beginner's guide to investing. In today's world, understanding how investing works is essential for building wealth and securing your financial future. Saving money is important, but inflation quietly reduces its value over time. That means the money sitting in your bank account today may be worth less tomorrow. This is where investing comes in. It allows your money to grow and potentially beat inflation. In this video, we'll simplify investing into 5 key sections. First, we'll cover the basics, what investing really means, and the types of investments like stocks, bonds, and mutual funds. Next, we'll discuss why setting clear financial goals is crucial, whether it's for retirement, buying a home, or funding education. The third section explores risk and return, helping you understand how much risk you're comfortable taking. Then we'll talk about diversification, a powerful strategy to manage risk by spreading investments across different assets. Lastly, we'll share practical tips on how to get started, from picking the right brokerage to developing a smart investment plan. Investing isn't just for the wealthy. Anyone can start, and the sooner you do, the better. Join us as we help you take control of your financial future with confidence. Investing is often a better financial strategy than simply saving money, and inflation is one of the key reasons why. Over time, inflation reduces the purchasing power of your money. For instance, $1,000 today may not buy the same amount of goods in 10 years if your savings only grow at a minimal 1% interest rate. Investing helps combat this by offering growth that can outpace inflation. When you invest in stocks, you become a partial owner of a company. If that company performs well, your investment grows in value, and you may also receive dividends, a share of the company's profits. Another major advantage is compound interest. Unlike simple savings interest, compound growth means you earn returns on both your initial investment and the profits it generates over time. This snowball effect can turn even modest investments into substantial wealth, helping secure your financial future more effectively than saving alone. Investing offers a proactive way to grow wealth, far beyond what traditional savings accounts can achieve. While saving is essential for emergencies and short-term goals, it often falls short against inflation. Investing, however, allows your money to work for you, helping build long-term wealth and financial security. By embracing smart investing principles, you set yourself up for a more prosperous future. For beginners, avoiding the temptation to chase trending stocks is crucial. These short-term gambles often lead to disappointment and losses. A smarter approach is investing in index funds, a strategy recommended by legends like Warren Buffett and Jack Bogle. Both have stressed that most investors are better off with low-cost index funds rather than trying to pick individual stocks. So what are index funds? They are mutual funds or ETFs designed to mirror the performance of a specific market index, like the S&P 500. Investing in an index fund means owning small portions of hundreds of companies, offering instant diversification and reducing risk. The benefits are clear. Index funds typically have lower fees because they don't require active management, plus their built-in diversification shields you from the poor performance of any single company. Historically, index funds have also outperformed most actively managed funds over the long term. For beginners looking to grow wealth steadily without excessive risk or fees, index funds are one of the best starting points. They offer simplicity, stability, and a reliable path toward financial independence. In conclusion, index funds offer beginners a smart, reliable way to start investing. By focusing on diversified, low-cost index funds instead of risky trending stocks, you can build a stable portfolio aligned with your long-term financial goals. Taking advice from legendary investors like Warren Buffett and Jack Bogle can guide you toward making sound financial decisions. Before investing, it's crucial to assess your financial readiness. 2 key steps are paying off high-interest debt like credit cards and building an emergency fund covering 3 to 6 months of living expenses. This safety net protects you from unexpected situations, allowing your investments to grow uninterrupted. The good news is, you don't need a large sum to start. Many platforms now allow you to invest with just $1, 0 cents, whether in fractional shares or index funds. Starting small is perfectly fine, and you can gradually increase your contributions as your finances improve. Timing also matters. Rather than trying to predict market highs and lows, adopting a strategy called dollar cost averaging, investing a fixed amount at regular intervals, helps smooth out market volatility and builds discipline over time. Equally important is committing to a long-term mindset. The true power of investing lies in compounding growth, which requires letting your investments grow for years without interruption. Money needed in the short term should stay in savings or easily accessible accounts. In summary, the path to successful investing starts with clearing debt, securing an emergency fund, and committing to consistent long-term investments, even starting with as little as $1. With discipline, patience, and the right strategy, you can build lasting wealth and achieve financial independence over time. Buying your first stock or ETF is an exciting step in your investing journey, and understanding the process is essential. First, it's important to choose the right type of account. Retirement accounts like 401ks and IRAs offer tax advantages, such as tax-deferred growth and possible tax deductions, but come with restrictions on when you can access the money. These accounts are ideal for long-term retirement savings. In contrast, taxable brokerage accounts offer flexibility. You can buy or sell investments anytime without penalties, though you'll pay capital gains taxes on profits. For beginners, a taxable account is often the easiest way to start investing while keeping funds accessible. Let's walk through how to buy an exchange-traded fund ETF using a brokerage account. ETFs are beginner-friendly because they offer diversification, owning a basket of stocks like the S&P 500 ETF EGM SPY, instead of just one company. By opening a brokerage account, providing basic personal details, verifying your identity, and linking your bank account. Once funded, use the platform's search bar to find an ETF that matches your goals, check its expense ratio, past performance, and the companies it holds. To buy, enter the number of shares and select an order type. A market order buys instantly at the current price, while a limit order lets you set a specific price. Review and confirm. Once executed, you officially own the ETF. After purchasing, regularly review the ETF's holdings and performance to ensure it still aligns with your financial goals. Most platforms offer transparent information about what's inside each ETF. In summary, understanding account types, navigating brokerages, and reviewing your investments are key steps to becoming a confident investor and building long-term wealth. Maintaining investments requires discipline, patience, and a long-term mindset, especially when market volatility sparks fear and emotional decisions. One of the most effective strategies for success is resisting the urge to panic sell during downturns. Investing is a marathon, not a sprint. Markets fluctuate, but history shows that those who stay invested are often rewarded. Take the dot-com crash of 2000 as an example. Many investors bought overvalued tech stocks only to panic sell when the bubble burst. Yet those who held their investments saw the market recover and grow in the following decade. Similarly, during the 2008 financial crisis, markets collapsed and fear drove many to sell at losses. But investors who stayed the course saw the market fully rebound by 2013 and hit new highs. A powerful way to maintain discipline is through dollar-cost averaging, investing a set amount regularly regardless of market conditions. This strategy lets you buy more shares when prices drop and fewer when prices rise, helping smooth out volatility over time. Equally important is ignoring short-term market noise. Daily price swings driven by headlines or economic reports often cause panic, but reacting to them usually leads to poor decisions. Focus instead on your long-term goals and the fundamentals of your investments. In summary, long-term investing is about patience, consistency, and ignoring short-term chaos. Start early, invest regularly, and let compounding do its work. Whether in stocks, ETFs, or index funds, the key is to take that first step and stick with it. With discipline and time, you can build lasting wealth and achieve financial security for the future. In addition to starting early, it's equally important to take consistent, actionable steps to grow your investment knowledge and confidence. We encourage you to subscribe to our channel and explore more of our content where we share valuable insights, beginner-friendly tips, and strategies designed to help investors at all levels. Remember, investing is a lifelong learning process. The more you educate yourself, the better prepared you'll be to navigate market changes, avoid common mistakes, and make smarter financial decisions. The key takeaway from this video is the power of long-term, informed investing. Building wealth doesn't happen overnight. It's a steady process driven by discipline, patience, and consistent contributions. By adopting a long-term mindset, diversifying your portfolio, and committing to regular investments, even in small amounts, you're laying the groundwork for financial growth and security. Historical events like the 2000 dot-com crash or the 2008 financial crisis have shown that investors who stayed the course and didn't panic sell were ultimately rewarded with significant gains as markets recovered. As you begin or continue your investment journey, focus on strategies that align with your personal financial goals, time horizon, and risk tolerance. Whether you choose index funds, ETFs, or individual stocks, the key is to make decisions based on research, not emotions or hype. This thoughtful approach empowers you to take control of your financial future. Equally crucial is the habit of regularly reviewing and adjusting your portfolio. The financial world is constantly evolving. Market conditions change, new opportunities arise, and your personal financial goals may shift over time. Staying engaged with your investments ensures that your portfolio remains aligned with your long-term objectives. It also helps you manage risks and take advantage of new growth opportunities. In conclusion, the most successful investors are those who start early, remain consistent, stay educated, and invest with discipline. Begin by addressing your financial foundation, paying off high-interest debt, and building an emergency fund. Then start investing regularly, even with small amounts. Commit to a long-term mindset, practice diversification, and ignore short-term market noise. Most importantly, never stop learning. Staying informed gives you the confidence and clarity to navigate the ups and downs of investing successfully. Thank you for watching. Your journey toward financial freedom starts with that very first step. Take it today, and let us help guide you every step of the way.